This is Cece, and this is the Orbit for Friday, October 13th. We've got a couple of the big bank reports out this morning, and what I want to do is look at the movement versus expected moves to start, and then we're going to discuss earnings trade management, particularly if you are doing credit spread income earnings type trading. So let's first look at JP Morgan. JP Morgan is up just under 1%. Options were pricing a 2.6 expected move. So as of now, it is well inside the expected move. Wells Fargo is up about 2.6%. That is just inside the expected move, which was more of around 3.1% for Wells Fargo. So it's inside the expected move, but it's close to being at the expected move. Next, we've got Citi, and Citi options were pricing like a 3.1% expected move. It is up about 2.6% pre-market. So very similar, actually, those two scenarios. Wells Fargo and Citi both were pricing about the same expected move. Both are higher, but just inside the expected move. A couple of other things, not in necessarily a bank here. United Health reported that it is up 1.3%. Options were pricing about 2.6%. So again, inside to the upside. And then finally, BlackRock is down 1.9%. Options were pricing about 2.9%. So within the expected move, not incredibly far away, potentially, for the open. But in all these cases, one of the things we want to look at when earnings seasons begins like this is, how are stocks working versus their expected move. And the prior earnings season, we came in and we were at a very low vol situation. In this case, we are not necessarily super high vol, but it is higher vol. And the VIX has been dancing around over the past week. For instance, its historical average, it is slightly under now. But these stocks have slightly higher vol going into this earnings season than they did last season, especially in a sector like banking, which has been sort of wild. So next, let's look at some options for income trading strategy management. All right, next I wanted to look at income from options style trading. So what a lot of traders will do is going into earnings with the assumption that earnings vol is high and it will collapse after the fact. They will sell option spreads, whether that's an iron condor, an iron butterfly, credit put spreads, credit call spreads. Traders also obviously position directionally. If they've got a bias that they think a stock is going to go higher or lower, they'll do that in the form of calls, puts, call spreads, put spreads. But let's first focus on credit spread trading. And in this case, with these reports coming out on a Friday and the options expiring, assuming that the trades were with options expiring this afternoon, it's not even close to being a vol play as much as it is an expected move play. So you are selling an iron condor, you get very specific strikes based upon the expected move, or if you want to push them a little bit outside the expected move, whatever it is, you are basically having a binary position. Does the stock move outside of that zone? It's as simple as that. And what will happen is the options where vol does come into play is the options that you use to construct this trade yesterday will look very different on the open today. So that's where you're going to see the vol go from 70 to 35 overnight, right? And so it's basically like it's the market essentially saying, here's how your trade did right off the bat, right on the open. And it's not necessarily all going to be there, right? If you sold something at 40 cents and you come in and it's worth 15 cents, you might have to wait all day for that 15 cents. So let's talk about that in particular. So here we're looking at Iron Condor and JP Morgan, and the stock is slightly higher. This is a scenario where it's still it's enough inside the expected move that you are going to see an instant profit on a trade like this. as vols collapse, and those options, a lot of the premium gets sucked out of them. However, of course, you're not going to see the entire potential profit right on the open. That is because stocks sometimes move a lot after they report. Yesterday was Domino's and Delta Airlines, and they opened higher and then completely reversed lower. Both sides of those moves were inside the expected move, but the range of which the stock traded from high to low during the day was about in line with the expected move. It was a very interesting situation. So in this case on JP Morgan, it's up to you. If you did an iron condor and the stock is slightly higher on the open, is that worth you're going to have more than 50% profits most likely. Is that what you were doing? Is that what you were in the trade for? Most people would probably say yes. Other people are saying, I'm going to hold out for the other part of this trade and see what the stock does. But in those cases, you need to be really careful because you don't want, it's not inconceivable that JP Morgan could open 1% higher and then in the first hour go up another 2%, or it could reverse. So these are some of the things to keep in mind. And so on the trade management page on Options AI, you can see those metrics and what your current potential max profit probability is, potential max loss probability. Those are all updated in real time. But also you can just see that updated expected move, right? So when the stock opens, that expected move is going to reposition. As the stock moves, that expected move is going to reposition. And it gives you a gut level feel of what's the potential for this stock that is in my position now profitable. What are the probabilities? What are the options market telling me that I'm going to get max gain, or I actually might lose money on this trade? And it's all very visual and easy to understand. And next, and quickly, let's just look at a couple other trade strategies. So now we're looking at a credit put spread that's out of the money, down at the lower expected move. JP Morgan is slightly higher. This is a trade that's probably going to be max gain, right? So unless JP Morgan were to completely reverse intraday and the market starts tanking, this is a trade that you got it right, and you're probably going to be max gain. You just need to keep an eye on it to make sure that the stock doesn't reverse down towards it. Next, we're looking at a credit call spread. So this one's a little bit more interesting because the stock is towards your trade, towards your short strike. So in this case, what you're doing is you're kind of weighing that likelihood, via the expected move and everything we were talking about with trade metrics. You're basically saying, well, I'm still good. This is out of the money. It has the chance to be max gain, but you need to be watching this one more closely, obviously. And it will probably, ironically, even though the stock is towards it, it may be profitable on the open. And that's because of that vol collapse overnight. So that's another thing to weigh is this is coming towards my strike. It is at risk, but I'm up money, right? That might be worth taking off the table. So those are the kinds of decisions traders tend to make on something like that. Finally, I wanted to do like a debit spread because this is sort of interesting in that what happens a lot of times with, the frustrating thing about options sometimes can be that you get the direction right, your long premium, but the stock just hasn't moved that much. So in this case, JP Morgan is about 1% higher, which in the trade we're looking at, which is a debit call spread, you'd be right near your break even here on that trade. And so what you're looking at here is, okay, I'm not down money, I'm not up money, I've got the stock direction right. And so on a trade like this, what you're really looking for is, does that move continue higher right after the open? And does this have a lot more potential to make money? Or does it look kind of dead in the water and it might even reverse, in which case you want to get out of a trade like that so you're not left with a worthless trade at the end of the day. This is a good way to think of intrinsic and extrinsic value in general, is if the stock were above your break even on a trade like this, time is on your side and you are not going to see all of your profits that you would see at the close today. immediately and you have to wait around for them, but time is on your side and it's going the correct way, if the stock didn't move the rest of the day, your gains would increase, right? Now, if the stock was below your break even on a trade like this, you are in the opposite situation. If the stock were to not move the rest of the day, whatever you saw as the value on your current position would actually decrease. And whatever you saw as your current losses, let's say, would accelerate. And that's because you are on the wrong side of your break even. Therefore, you're benefiting from your trade having an extrinsic premium left in it, but that will quickly decay away via very rapid theta throughout the day.